Welcome back to Buck Talk. Today we're going to be talking about venture capital. In particular, we're going to be talking about a little pet peeve of mine. So, venture capital investments are usually run as funds. So, if you're a venture capitalist, you raise a fund, you get a bunch of money from investors, maybe some of your own, and you put it all together, and then you invest in a certain amount of early stage companies. I say certain amount because it could be anywhere from 5 to 10, which would be pretty small, all the way up to 50 or 100, which would be a lot. We'll talk about 25 today as kind of a reasonable baseline. And for the sake of example, usually those funds last 7 to 10 years, and you're aiming for a high return because they're very risky investments. Now, they are spread out, so you're not having all the eggs in one company, but if tech does poorly, if it was a bad year to be deploying capital, you might not do so well. So you're hoping for high returns. Now, there's a lot of great venture capitalists, a lot of great VCs, people who are doing the investing. But there's also a bunch who don't seem to understand math. And let's talk about why. So the pet peeve that I want to talk to you about today is a lot of venture capitalists say that the price they invest at doesn't matter. It's totally wrong. It couldn't be any more wrong. There is a little grain of truth to that idea, where, of course, if you're going to invest in a company and it's going to do just absolutely amazingly, it's going to be the next Facebook, next Amazon, next Google, whatever. Of course, if you passed on that because it was twice as expensive as some other company, you would regret that. But a lot of venture capitalists don't seem to understand that you can't generalize this idea to all prices. And I think it's because the compounding math is kind of hard to do. I don't know why, but there's a lot of venture capitalists that genuinely don't seem to understand this. There's one who I heard talking about this who definitely did. It was Zach Weinberg. He was on a recent Cartoon Avatars podcast. But anyway, a lot of venture capitalists who seem to be good, at least successful investors, really don't seem to understand this. So let's take a look at some of the numbers why, and we can maybe get a better look at the intuition. So I put together the spreadsheet for us that I've called VC Portfolio. I put a little toggle for us to use for how much they're putting into each investment, and obviously you can, multiply all these numbers by 10, divide them by 10, whatever, it'll still be true. And then I put a little variable for how long the fund's going to go. That only matters when we're calculating the returns at the very end. I needed to have the variable there. We'll just stick with 7, which is going to make the returns look pretty high. But we could also put it at, 10. That would be fine. Let's look at 7 for now. And then let's look at the companies. So we'll make a few simplifying assumptions. We'll say there's 25 companies, and we'll assume that our fund invests $50,000 into each one. Now, here's what we'll assume the results are. We'll assume that 3 of the companies get to close to 0. So they return only a tenth of the money that we originally put in. We'll assume that 5 of the companies return what we put in originally, but nothing more. That'd be kind of a lousy investment over 7 years. We'll assume that 5 more double our investment. It's not really what you're shooting for, but it's okay. We'll assume 5 more triple the money. We'll assume 5 more quintuple the money. We'll assume 1 does really, really well. It's worth 10 times as much. And we'll assume there's 1 absolute home run, 100 bagger, gives us 100 times our originally invested capital back. Okay, so here's the funds coming out from each of these investments. So you can see we put in a little over $1 million, $1.25 million, and we got back 8.2. That's a multiple of 6.6, which is not bad. Not bad at all. And that's an annualized return of 31%, right? We'd be very happy with that. If we could sign up for that ahead of time, we definitely would. Now, when VCs or anybody talks about, in venture capital, the price you invest at doesn't matter, usually they're thinking about investment number 25 down here, this 100 bagger. They're thinking, if you're investing at 100,000, you'd still do amazingly. And this is an idea called the power law, where most of the returns from the fund come from one investment, right? If this investment, was just even 500,000, instead, right? You see the returns almost half. We got 17% a year, a 3x multiple instead of 31% a year and a 6.6 multiple. That's what they're thinking of. But when you use that to justify expenses for investments in all the companies going up, it just doesn't make sense. And let me show you. So again, if we wanted to plug in, hey, what if we paid double for this company? What if we paid $100,000? How much does that affect things? Okay, 6.4 and 30%. Barely move the needle. What if we paid 200,000? 5.9, 29%. Barely move the needle. This is what they're talking about. But then, I'll just undo that real quick. That gets conflated with, oh, it doesn't matter how expensive we're investing in all the companies that we're putting in our fund. And that's where it's just wrong. So let's look and say, hey, what if the value or the price that you invest in all the companies doubled? What if that goes up to 100,000? Now we cut all our multiples in half, and we cut our multiple in half. And our annual return's now down to 19%. It's still pretty good, right? You'd still like to have 19%. But you've taken a ton of money off the table. And if you increase the number to 200,000, so we multiply the original 50 by 4, this is pretty pedestrian, right? Now all of a sudden you're getting 7% annual return and taking a lot of risk for it. That's no good. And we've actually seen multiples move up, I'd say more like this, 4x, if you look over the past 5 or 10 years. And I think a lot of VCs are either not good enough at math to be able to figure out that, yeah, the price you're investing in all these companies really matters, or maybe there's some motivated reasoning. You know, if they can't really go to their LPs, their limited partners, people who are putting money in, and say, oh, yeah, you know, the market's too expensive. We don't think you should be investing with us right now. We're just going to wait for things to cool off. That's a pretty hard thing to say. It goes against their interests more than I think most people would be able to stomach. So I don't know why, but a lot of venture capitalists, again, even good ones who are very good at their job, which is investing in companies that will do well, don't seem to be able to fully grasp. Big pet peeve of mine. Hopefully after seeing this little breakdown, you understand it better. Talk to you next time. Subscribe for more pet peeves.